The trade I took today made me over $1,000. Within 10 minutes of work, my strategy gives me consistent days like this, and this. But if you want to take signals for the rest of your life, then please skip on to the end of this video, because this is only for the ones that truly want to learn. Alright guys, so straight into the price action. So basically what we have on the daily chart right now, we had a little bit push onto the downside. We were longing on this specific day, which was on the Wednesday. We saw the FEG that we had right in here, as we all know. FEGs love to be traded back into. If you go back in the chart, most FEGs like to be traded back into. And I would say I don't have a specific percentage on how to tell you how much it's exactly going to be, but for the most part we always trade back into the FEGs. Now if you go back into the chart, of course there will be examples where we left off the FEG and we never returned back and it hasn't been filled for 5 years. Nothing works 100% of the time, but if you can determine a specific pattern in the market, such as that FEGs love to be traded back into, you can already build an entire framework off for that. Now the reason why we took the trade on Wednesday was not only the FEG, the daily FEG. I'm not going to mark it out. It was also the relative equal highs that we had in here. Strong confluence, I said it many times before. If you have relative equal highs combined with an FEG, very high probability setup. Most of the time it's going to get hit. Rare occasions where it's not going to get hit, then you might get a loss, but they can be easily recovered. Now the same goes also for the downside. We had relative equal lows. Now in order to go higher, we need to go lower first. We took out the relative equal lows, which is the reason why we went higher. Now going on to weekly chart, because I need to mention that a little bit. So as you can see, we have 1, 2, 3, 4, 5, 6, 7, and this is the 8th candle. Now if you go back into the chart, you cannot spot a lot of candles, a lot of consecutive candles of the same color or of the same direction for that sense. Because if you go back into the chart, now, of course, once again, you will have days or periods where the market just has, like this one, 8, 9 or whatever many candles in a row of just one direction. That will happen. But most of the time, the more consecutive candles you have in one direction, the higher the likelihood that the market will have another candle onto the opposite side, right? So we have a bunch of bearish candles. That makes it way more likely that either this week, this week is a little bit less likely because it's already a Friday, but next week will be a bullish one, okay? That is already telling us the downside is pretty much over for now. We have a couple of things that are speaking against our argument here, because if we go onto the daily chart, now let me actually stick to the weekly once again. We can see we have a lot of weeks right in here. That is suggesting to us that we'll go to the upside once again, because that means we're just taking the sell side liquidity out of here. And in order to go higher, we need to go lower first, which is exactly what we did. Now, to be honest with you, this wick right in here, this weekly was a little bit of an unexpected move. I would have likely seen that it will go below these relative equal lows and then push higher. But then once again, that would also create another problem, because if the wick would only go onto here, take out all of these sell stops, then we would basically create, even more relative equal lows, and we have another reason to go lower. So that actually makes sense that we're not creating a pattern like this, but rather we're taking all of the sell side liquidity out, and now we go to the upside. Now guys, you can have the best strategy, the best risk management, and also be a master at psychology, but every professional trader needs a professional journal. That's why I personally use TradeLens. Now if you want a 10% discount, it's the second link in the description. Some people might say, well, but now we have relative equal lows once again, but I have to be real with you, those are not relative equal lows, because this is not relatively equal close to each other, as the name suggests. We don't consider that as going lower once again. Now going on to the daily chart, when the candle was just opening up, the bias was already bullish, and it is in fact still bullish for the entire day. Now keep in mind, it is a Friday. Fridays are the worst trading day of the week, and I'm speaking for many people, not just me, but also in my own statistics, I have not been as profitable on the Fridays as I've been on the Tuesdays and Thursdays, which is in fact the best days for me personally. So you have to keep that in mind in order to not take bad decisions, but we'll trade this very carefully. And once again, when the candle has just opened, our bias was bullish when taking out the previous day high, because once again, if you have seen my previous day low and previous day high video, how you determine the daily bias, is it more likely that the candle will return all the way onto this low basically, or is it more likely that the candle will return all the way to the previous day high? Now, just by looking at it, just taking a guess, right? If I just skip, just by looking at this, what's more obvious to happen? Of course, we're going for the high because we're just so close, right? So you have to keep it very simple. It doesn't have to be complicated in that sense. if we're already so close onto the previous week high or previous day high, then we might as well just go there. So this logic has been applied for the weekly chart. I wouldn't say that you can apply it on every single chart, because people like to say that the market is fractal, but I only partially agree with that. The reason for that is because yes, the market is fractal in the sense that the patterns like to be repeated, but at the same time, things that work really great on the daily chart might not work as great on the minute chart, on the 1 minute chart or 5 minute chart, right? Especially because you have so much frequency compared to the daily chart. It's not as reliable, right? Let's just assume you can have 10 pips within 5 minutes. That's the max amount we ever had in history. But then on the daily chart, it was 500, right? So that already, you cannot compare that kind of price action. So it is fractal as a conclusion, but not 100%. You shouldn't rely on it. Yeah, going on to the 4 hour, this will definitely come lower. So we were talking about that there is something that speaks against us. Now, the thing that is speaking against us, we have relative equal lows in here. The problem that we are creating right now, currently in the market, is that we want to go higher, but we still have a counter argument. I have told you in previous videos and also lectures that you would prefer that you only have things that speak for you, but the reality is you will always find something that speaks against your trading idea. Now, your job as a trader is not just to look at, okay, we have relative equal lows, but we also are more likely to go bullish. Now, I'm just going to take a guess. So you have to kind of weight the confluences. How much weight does this relative equal low hold? And how much weight does everything else hold that we have just talked about? Now, another thing that I want to quickly mention before I talk about those relative equal lows further, we also have a premium to discount range, which we have not been traded back into. Now, premium to discount range is basically the same principle that I've previously applied to everything I've just said. Most of the time we like to return back into it. Now, of course, you can take multiple levels, right? You can take it a step further and say, I'm having some kind of level in between the equilibrium and the premium area that I'm looking out for. That's also an option. But from my backtesting, we love to return at least to the equilibrium. And after we did that, my analysis changed, right? So then I would most likely draw a premium to discount from this low onto this high, wherever it's going to stop, right? So by having this kind of framework, we have definitely intentions to go higher. There are just more things that speak for it. Now, going on to the 4-hour chart once again, because I want to talk about those relative equal lows. There's a rookie mistake in this way of trading that you see something that speaks against it, especially crystal clean relative equal lows, right? If the relative equal lows are this clean, then I might as well also just short it, because I'm the biggest fan of relative equal lows and highs. But once again, you have to stay objective and you have to weigh the confluences. Weight does the relative equal low have compared to the premium to discount, compared to the weekly chart that I've just shown you, compared to everything else basically. Now, what does hold more weight? Of course, the upside. So we're going to trade accordingly. Going on to the 1-hour chart, this candle will go lower, right? Or maybe it's not even going to be this candle specifically, but we will most likely, first of all, take out those relative equal lows on the hourly chart. Now, the thing that speaks for us short term, we have already fulfilled this premium to discount range. So we're likely not going to return back into the equilibrium. It's not needed. Now, a very likely scenario in here will be that we will go down onto the relative equal lows, taking it out, having another fake out just with a wick, and then just going onto the equilibrium once again. Which is, so a lot of people would just see this directional move and say, okay, I'm just going to long it right now. And I can already see a bunch of people skipped to this part of the video because they saw the trading tool. Now I'm going to remove it because we're not going to take the trade yet. Guys, be patient. Now, another thing that is also speaking for us, we have this wick, we trade into this FEG. This kind of wick is likely to be taken out. Now, how do I know this? This is just based off from my back testing, my experience. We love to trade back into those kinds of wicks a lot of the times, which is why this wick is not going to hold. And it's not just a random wick that I'm looking out for in the market, okay? If you go onto the 4-hour chart and I'm going to mark out this low. Now, although it got hit, this is just a random low I have taken out from the chart, okay? There is no logic behind it. Logic behind the other wick that I'm meaning right in here is because we traded into an FEG, right? So it has to be that combination. It can't be just a random low or high you're marking out and saying, okay, this is high probability, this is low probability. You have to have this kind of combination to tell, okay, a lot of the times we like to trade back into it. I have to repeat this a lot of the times, but if you're taking one of the concepts that I'm showing you, basically relative equal lows, the FEGs or whatever, and you're trading the concept just on its own, it's not going to work. It might work a couple of times, especially with low risk reward, You can just take a random trade and you will most likely win. But if you take one concept and trade it on its own, it's not going to work long term. You have to combine it with at least two. The more confluences you stack up, the better the quality of the trade gets. So basically what we're trying to look out for is for a continuation higher on the short term. Now, after we have gone higher, the story can change, but I don't want to predict too much in the future, because the longer we go into the future, the harder it gets to have a precise measurement of how the things will be looking like. But as a very broad overview, I am looking forward to take out those relative equal lows, but just not yet, and especially not today. Now, another thing is also we have relative equal highs in here. Also another point that we will go higher, but so those relative equal highs, they don't hold much weight because they are far into a premium, right? And if it goes higher in here, it might also take out this high, and if it takes out this high, we create, another relative equal high, and then the story just repeats itself. So you see, this is basically an entire rabbit hole that we're trying to figure out here. Those don't hold much weight, but it is still additional information that we're just going to look out for, and I wanted to mention it. So how is the trade looking like? For anybody that has just skipped onto the video, because you can see we have a trading tool, and people love to skip to this part of the video because they just want to see the trades. Now you can, of course, just only take the trades that I'm giving you, but if you're not going to actually listen to what I'm telling you, then you will never be able to do it yourself. Now the trade is not looking exactly like this. We want to wait until it gets onto those relative equal lows, and then our take profit will be about 10 pips and your stop loss way lower. Ideally you would have like it to be below that low, but I'm just going for a almost 50 pips stop loss, and that's a trade. Now if you're just going to leave this on your chart, don't be surprised if this is going to lose, because you have to adjust what I'm telling you right now. Once we have gotten onto this high, you close the trade, okay? So let's just say that price, we have our stop loss, our take profit, our limit order. Let's just say that price hovers around, barely doesn't touch your limit order and just goes higher and higher and then takes out this high. You remove the trade. Simple as that. You remove the trade, and I don't care if you're thinking, well, but this could have been a win and whatever, I'm going to enter. No, don't do it. You have to let the trade play out and trust the analysis. So we're not going to change anything. You can literally take the trade right now and you will most likely end up making money if it goes back into limit order. But if it didn't get to that high beforehand, you have a trade. I also like to look at the monthly here and there, because the monthly is also telling us that we have a price gap. Price gaps are basically the same as fair value gaps, but I like to call it the big brother of FEGs because they are more likely to get hit. A lot of people would suggest that we have traded back into the wick. Yes, we did, but we have to get to it with a body closure. Before we have not gotten to it with a body closure, this entire gap stays intact, right? You can even mark it out very, very big and have it on the chart the entire time. Now, the reason why I don't like to have things on the chart the entire time, because psychology wise, right? If I have a bunch of things on the chart, first of all, I can't concentrate. And the second thing is, if this line just stays there forever, then I start to idolize the idea that we're going to go higher, and then I'll just take losses, right? So I like to always have a fresh start onto the day. So I've just marked it out for everyone that has been wondering and wanted to see it. But as a whole, as a general tip, don't have the drawings out all of the time unless you're really sure and based on your back testing. So not just random data that you've been looking out for the past 5 or 10 minutes and saying, okay, that happens in the market sometimes or most of the time. And then you're drawing a conclusion out of it. Okay, I'm going to take a trade every time that happens. No, you have to collect at least 2 years worth of data to say that, okay, my strategy has edge in the market. This is my opinion. But if you have your drawings out on the chart the entire time, then you start to idolize the idea, because even if this premium to discount stays in here the entire time, me personally, I'm starting to begin that we will definitely go higher. And even if we go lower, right? Now, this will be a different scenario. Once again, we would have to adjust our premium to discount, but that is another topic. I start to idolize the idea and I just want to long. I don't care about any type of shorts, even when we have relative equal lows, even very clean ones, right? And that is the problem. Make sure to always have an objective view on the market. You have made it this far into the video. And let me be very clear about this one. You can go 2 paths in trading. Either you're taking the path that I had to take, which led me to countless of platform challenges being blown, and also personal accounts that I have lost. The list goes on. Or you can also take the shortcut, being mentored by somebody who has 5 years of experience, more than 500k in total funding, and also multiple prop firms. Now, I have been interviewed by prop firms where I basically explain how I've gotten to all of those payouts. When you're trading for this long, your win rate is extremely high. That's why we barely get into any kind of drawdown. Now, and this is not just a regular mentorship, you will get access to everything I've learned over the past 5 years of experience. So if you want to learn how to get the same results, it's the first link in the description.